Good day, traders. I hope everybody's having a wonderful afternoon, a wonderful day, a wonderful evening, no matter where you are. And today we're going to be discussing technical indicators. Now, not technical analysis, but technical indicators. Now, technical analysis is the entire field of any type of analysis we do. Basically, we could term it any type of chart analysis. Anything and everything you do on a chart falls into the field of technical analysis. And one of those sectors is the area of technical indicators. Now, I would appreciate greatly if you could subscribe to my YouTube channel while you're watching this video, or just click the bell icon down below. I promise you we're not going to send you emails or bother you about anything. Just so you'll get a notification whenever I upload a new video. So please subscribe. So technical indicators are just what they are, indicators. Indicators only indicate, or we can think of indicators as the interpreters of the market. They're the interpreters of price. So when price is speaking one language that you can't understand, you can use a technical indicator to try to interpret what they're saying to you. Imagine price is that big speaker at the UN standing up on the podium speaking in a language you don't understand. You got the headset on and you have an interpreter telling you what he's saying. Well, let's go on a little farther. You've got the guy up there speaking. We'll call him Mr. Price. Mr. Price is up there speaking, and he's speaking in Forex language. So we have Mr. Price and we have Forex language. Okay, now, because you're a pretty worldly person and you're a pretty smart and well and educated person, you speak your own language, which we can call currency, but you also learned a good deal of Forex. But you're not fluent in Forex yet. So to help you from making mistakes or help you to really get the innuendo, you have a headset on and you have an interpreter who's interpreting, is an excellent interpreter in Forex and currency. So that interpreter's taking what Mr. Price is saying in Forex and interpreting it into currency so that you fully understand it without making any sense, without making any mistakes. So that's what technical indicators are. A technical indicator is a mathematical calculation that can be applied to an asset's price patterns like price, volume, and even to other technical indicators. They alert, they predict, and they confirm. Now, since Mr. Price is the only one in control up there, we can put Mr. Price on a chart, and what we're trying to do is figure out what Mr. Price is saying. However, from time to time, those charts may be speaking a language you do not understand, and you need some help from an interpreter. Technical indicators are the interpreters. They look at price information and translate it into simple, easy to read signals that can be used to determine when to buy and when to sell an asset. Now, Mr. Price up there has his panel of price people, okay? Or we can call them asset people. So you have Mr. Euro up there, you have Mr. Dollar up there, you have Mr. Swiss franc up there, you have Mr. Pound up there. Now, each one of them get up and speak in their own language. Now, the interpreter that's in your head translating for you needs to become a specialist, because that interpreter needs to be able to talk pound to currency to you. The next interpreter needs to be able to listen to what Mr. Dollar is saying and interpret that to your language. And Mr. Japanese yen is speaking in yen and interpret. So you can either have a multi-trained interpreter or several different interpreters that are interpreting each language up there. That can be very, very, very confusing. I just got confused telling you that. So we have different interpreters or different technical indicators. A technical indicator offers a different perspective from which to analyze price action. Some, such as moving averages, are derived from simple formulas, and the mechanics are relatively easy to understand. Others, such as stochastics, have complex formulas and require more study to fully understand and appreciate. Regardless of the complexity of the formula, technical indicators can provide a unique perspective on strength and direction of the underlying price action. Now, technical indicators are based on mathematical equations that produce a value that is then plotted on a chart. For example, a moving average calculates the average price of a security in the past and plots the point on your chart. As your chart moves forward, the moving average plots new points based on updated price information. Ultimately, the moving average gives you a smooth indication of which direction the asset is moving. That's an indicator. That's a simple indicator. We have complex indicators, we have simple indicators. But guess what? No matter how complex or how simple they are, they only have a handful of numeric values they can pull from. They all have strange formulas like Bollinger Bands that uses, oh, the word just went out of my head. Standard deviation, which is a very involved statistical calculation. You have things like MACD that use four steps removed of an indicator. There are 4 steps of each calculation to form MACD. And then you have other ones that are based on volatility. Some are based on the strength of the trend. But they all use the open, the high, the low, and the close and volume. That's it. Because that's all the numbers that we have. Now, they sort them in different ways. They shake them up and down. But that's all that we have. Now, to begin looking at indicators, we have 2 different types of general indicators. We have what we call leading and lagging indicators. Now, leading and lagging are not the same words that we use when a teacher calls you about your kid and your kid's leading the class or leading behind the class. Leading the class, he's great. Lagging behind the class is pretty bad. Okay. Most indicators are lagging. Leading indicators give trade signals when the trend is about to start. Or lagging indicators are those that follow price action and tell you or confirm that something has happened. Since you're using, in most cases, the most recent bar or the most recent price, and you're using the close of the most recent price, it can only be lagging because it's using a price that already happened to give you something. So it's not predicting the future. It's telling you it has to wait for that close to give you the calculation. So most indicators are lagging, but that's not a horrible thing. That's what I'm saying. And leading and lagging is not like good and bad. Lagging indicators give a signal after the trend of reversal has started. Use them to determine a trend, and most common lagging indicator is MACD or moving average. Okay, because what do you want to know? When the trend is starting, or that the trend you're in is, or the current trend is just ending or has ended. Okay. Leading indicators try to predict price by using shorter periods in their calculation, thereby leading the price movement. Okay, so those are the 2 general areas. So remember, leading indicators. Leading indicators precede price movement and try to predict the future. Lagging indicators follow price movement and act as a confirmation tool. From there, we break technical indicators into categories or types. Okay, so we have one type, and this is important because what happens is too many traders don't understand the different types of indicators, and they don't understand lagging and leading. So what happens, their buddy says, oh, I use RSI and stochastics. It's actually a very popular combination, except it's a stupid combination. Because both of them fall in the same field and give you the same information. So if one is wrong, the other is wrong. Okay. So what you need to do is combine indicators from different categories or different types so that they have some value to you. They spot something right or wrong in the markets. So one group is called trend indicators. They measure the direction and trend and strength of trend. Then we have momentum indicators. They are very, very important. They analyze the strength of the move, the momentum that the move has. So if you have something that's trending up and it's trending up very hardly, so you see, you have a deep trend and there's lots of movement, and so you've got a trend indicator that tells you it's trending. You've got a momentum indicator that tells you, oh, it's got a lot of strong momentum, and then you see a drop in momentum. It doesn't mean the trend is changing, but it's a worrisome sign because something is moving up, 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 and then it loses its speed. It loses its momentum upward. Means it could be falling back down to earth. So we want to investigate because a trend, an asset moving up, can lose some of the speed, its momentum, and continue moving up. But we need to be aware of this. Then we have volatility indicators. They measure the rate of price movement regardless of the direction. This generally based on a change in the highest and lowest historical prices. So volatility is telling us how big the jumps are in the market in every time swing. Volatility, number one, will help you decide where you should put your stop losses and take profit points. And when a market is getting volatile or volatility is increasing while it's trending and while there's momentum, there's a problem because volatility should be staying relatively the same as prices moving up momentarily. So if we get an increase in volatility, again, it's telling you there's a problem. Then we have volume indicators. That measures the strength of the trend or confirms a trading direction based on some averaging or smoothing of raw volume. Volume is very important because if the trend is moving upward, momentum staying steady, volatility is remaining steady. Okay. We want to see volume either steady or increasing. If volume is increasing and you're looking at a buying scenario and everything's there and volume is increasing, means the other traders are jumping in and buying too. When volume drops, it tells you for some reason a lot of traders have jumped out of the market. Now, let's start with some tips. We talked about the categories. Covering more than 5 indicators is futile. Even 5 is difficult. Okay? Because you forget, these are indicators. See, for instance, I use trend lines, support and resistance, and trend patterns on my charts. And then you start putting all of these different indicators on your chart. It gets to be so confusing that you can't figure out what you're doing. Okay. But focus on 2 or 3 indicators and learn the intricacies inside and out. Never choose indicators that generate the same signals. Always choose indicators that complement each other. Confirm your strategy by using an additional indicators to substantiate a trend suggested by one indicator. Learn what indicators are and why you should choose one indicator instead of another. So to find the best technical indicators for your trading approach, test out a bunch of them singularly or then in combination. But the easiest way is take one that your buddy told you about. Take one you think is nice. I started trading with MACD. Now, I love MACD. Okay. But I'm really not an indicator trader. I'm a price level trader. And I'm, like I said, trends, chart pattern. But when I have to tell a story of the markets, I use MACD. I started trading with MACD or learning about MACD. You know why? I like the name. Moving Average Convergence and Divergence. That was the only reason. Okay, it happened to be, it turned out I liked the indicator also. But regardless of whether you're trading stocks, Forex, or futures, it's often best to keep it simple. Use the KISS method. Keep it simple, stupid. Okay. You may find you prefer looking at a pair of indicators to suggest entry and exit points. And most use only one from each category to avoid redundancy. Technical indicators are mathematical calculations based on a trading instrument's past and current price and volume activity. Technical analysts use this information to evaluate historic performance and to predict future price. Indicators do not specifically provide any buy and sell signals. Okay, what I like to say is they create buy and sell alerts. Indicators are indicating and they're telling you, they're interpreting, they're telling you, hey, here's an opportunity. A trader must interpret the signal to determine trade entry and exit points that conform to his or her unique trading style. Several different types of indicators exist, including those that interpret trend momentum, volatility, and volume. But avoid redundancy. Multicollinearity is a statistical term that refers to the multiple counting of the same information. This is a common problem in technical analysis that occurs when the same type of indicators are applied to one chart. So you want to avoid redundancy. So let me pop you over. I got some charts up and some indicators up there. So here is my standard teaching charts, the Euro US dollar. Now down below is my favorite indicator, MACD. So MACD for me tells everything. Now on the chart above, I have a 12 and a 26 period moving average. Now these could be a simple crossover moving average, but they're also the same calculations that are used for the MACD line down below. So everything that's contained in those two lines on the top of the chart are actually contained in this blue MACD line down below. I don't need them at all. So I can then avoid redundancy and confusing my charts by not having them. Now, here's a simple little trading system. Lots of lines on there. There's only one indicator, and that's Bollinger Bands. We can take it off the chart and we can hide it for a minute. And now you can see we have our support and resistance levels. We have our chart patterns. And we can drop over top of it a simple indicator like Bollinger Bands, which gives us a moving average in the center anyway, and will give us trading opportunities. We don't need to be overly complex. So we want to avoid redundancy, we want to avoid confusion, and we want to have a system that's easy to filter out and also easy to see false signals and easy to see opportunities. So I'm going to show you a little presentation here using a couple different, well, first we're going to look at 4 or 5 of the most popular indicators, and then we're going to combine them together into a simple trading strategy, but at all times avoiding redundancy. So hold on tight and let's get this presentation ready for you, and hopefully by the end of this little presentation you've got technical indicators down pat. So thank you very much for joining us, and we'll talk to you again soon.
Indicator 1, RSI. The Relative Strength Index compares the magnitude of recent gains to recent losses in an attempt to determine overbought and oversold conditions of an instrument. As you can see from the chart, the RSI ranges from 0 to 100. An instrument is deemed to be overbought once the RSI approaches the 70 level, meaning that it may be getting overvalued and is a good candidate for a pullback or reversal. Likewise, if the RSI approaches 30, it is an indication that the instrument may be getting oversold and therefore likely to reverse. Traders will often use the RSI either coming back out of its overbought or oversold areas as a signal or partial signal to enter a trade. As we can see, the RSI is often accurate when indicating when a market will reverse. A trader using RSI should be aware that large rallies and drops in the price of an instrument will affect the RSI by potentially creating false buy or sell signals. Traders often combine the RSI with other indicator signals such as MACD crosses. Indicator 2, MACD. The moving average convergence divergence is one of the most well-known and used indicators in technical analysis. This indicator is made up of 2 exponential moving averages which help measure momentum in an instrument. These moving averages and the changing distances between them become the MACD. Convergence simply means the moving averages are moving closer together, and divergence simply means they are moving away from one another. When the shorter-term moving average is above the longer-term moving average, this area of the indicator will show activity. When the shorter-term moving average is below the longer-term moving average, this area of the indicator will show activity. The center line, of which the MACD is plotted around, indicates where the moving averages are equal, and when the MACD passes through the center line, this indicates the moving average is crossing. The signal line, here in red, is a moving average of the MACD values themselves. Typical values for the MACD are 26 and 12 exponential moving averages and 9 for the signal line. The farther apart the moving average is, and the greater the momentum, the farther away the MACD will be from the center line. Traders use MACD and signal line crosses, such as these, to indicate momentum trades. You can see how these crosses often match up with market moves. Traders also use the MACD crosses to indicate when momentum is coming out of the market and may use it as a signal to exit a trade. Indicator 3, Bollinger Bands. A Bollinger Band starts off with a simple moving average. It then has two standard deviations plotted away from it. That sounds a mouthful, but the important part is because standard deviation is a measure of volatility, Bollinger Bands adjust themselves to current market conditions. When the markets become more volatile, the bands widen, move further away from the average, and during less volatile periods, the bands contract, moving closer to the average. The tightening of the bands is often used by technical traders as an early indication that volatility is about to rapidly increase, as volatility often follows periods of lack of volatility. The markets spend most of the time within the bands, and when the price action reaches the edge of the bands, it is often more likely to reverse and come back into the range. This is used as a signal by reversal traders to take a trade. This is similar to the oversold and overbought conditions of the RSI. Indicator 4. Supertrend indicator. The Supertrend indicator is an excellent indicator of trend direction. It can be used as a foundation of a trading system that is based on trend following. One of the most popular ways to use this indicator is to enter the market after a pullback. For example, if the market is on a downtrend, indicated by red, wait for a green pullback and then re-enter the market once it turns red again. The same can apply in uptrending markets. Here we can see how this indicator accurately tracks market trends. It can be refined through the settings to match the specific instrument. Indicator 5. Confluence. The last indicator isn't a new one, it's indicator confluence, which means to use multiple indicators and their signals to take a trade. Here we have the RSI and MACD we looked at. We have the RSI moving into overbought territory here. Remember that indicates the market will reverse. However, we want to help us filter out false signals on the RSI, so we also look at the MACD to give us confluence. We can see it is indicating the momentum has come out of the market, as far as the market rallying or going up is concerned, and we have an MACD cross here. A signal to enter this short trade could be waiting for the RSI to come back out of the overbought and also waiting for the MACD cross. We can see that those combined signals are an indication that captures this trend. You can also use the opposite signals to indicate when the momentum is coming out of the market and it's more likely to reverse and the market to retrace back up the opposite direction of our trade, and therefore is an exit signal. In addition to the RSI and MACD signals, we can add further confluence to this trade with a Bollinger Band and the Supertrend indicator. We can see the market has hit the top of the Bollinger Band here, but we could also wait for the Supertrend indicator to change red here before taking the short trade. So now we have the confluence of 4 indications. We have an RSI coming back out of overbought, we have an MACD cross, we have the market going to the edge of one of the deviations on the Bollinger Band, and we also have the Supertrend turning back to red.